Hey, fantastic fam. Welcome to our community where we combine the woo and the work. We are two professional women who believe we can have it all and constantly upgrade ourselves to meet our visions. I'm Kalyani and I've chosen the off-roading path to personal development, being an entrepreneur with the journey of motherhood. I'm an economics postgraduate and I love working with all things mind and money. I've founded and sold one business and I'm now building this business that feels like fun and freedom for life.
Hi, I'm Rupali. I'm a numbers nerd turned Reiki master and many other things. I found a passion for all things wellness. I've worked in banking and finance for 15 years and I love combining that knowledge with all things energetics to create impact in a fun, easy way for others. Join us as we share the behind the scenes of us creating wealth, freedom and magic.
Let's speak about what the markets, US markets in specific, have been doing for the month of November, which is when I'm recording this, November 2024. This is straight after the US election results have been announced and Trump has been re-elected. And now, whatever your political views may be around this topic, I would love for you to put them aside. I request you or urge you, encourage you to put them aside and simply just look at the markets as a money-making vehicle, which is politically agnostic, I would like to believe. From all the data that we have come across, whether it was anti-incumbency wave or there was kind of more of a pro-incumbency approach, meaning whether the voters were kind of tending towards voting for change, meaning someone new who had not been in office before, or they were tending towards voting for the same candidate who has done good work over the last couple of years in the US. Either ways, what the stock markets do not like is uncertainty. Once that uncertainty is over, then we have conclusive evidence, conclusive data to see that the stock market tends to be fairly bullish in the months following the elections. So this year, following this pattern, we had volatility for the month of September and October. Generally, September tends to be a bearish month, which is because a lot of this is going by the typical routine, typical annual pattern that is seen around across the globe, where a lot of fund managers come back from summer holidays in the month of September and they need to close a lot of their pending positions. They need to also book these positions for upcoming taxes. Many of their financial years are ending in September. So to kind of book the impact of their trades, they close these positions, which are typically large positions if these are institutional investors. Then this leads to the big money making either profits or losses. If these are loss-making trades, then that has a massive impact on the market, and this is why generally the month of September is net bearish. This year though, in 2024, the month of September was actually fairly bullish, and also leading up to the election results, which came out on 5th or 6th of November, based on where you are, based on your time zones. October wasn't bad either. So it was almost as if the stock markets were pricing in. This is a concept that I'm going to explain in just a second. They were pricing in the victory of Donald Trump. And why this was important is because the business community sees his presidency as something that is business positive. It's positive for the business because of lower taxation. He's more about domestic production, domestic manufacturing, and all-round kind of encouraging of local businesses. Making America great again also resonates a lot with, of course, the local business community. And the stock market was reflecting this positivity in advance, which is what we see often. Stock markets are often they often move based on perception of news, which is basically on a very whimsical kind of rumor-based public perception, where if there's any little chance of something happening, good or bad, then that tends to snowball into a much larger effect that is seen in the numbers, that is seen on the charts. And big money, which is institutional investors such as banks, hedge funds, etc., they tend to act on this perception as well. So this is what we call as pricing something in, meaning it's already prepared for what it thinks is going to happen. Sometimes it's right, sometimes it's not, but it already is acting preemptively on the basis of what it thinks is going to happen. So we saw a recent effect of this, like I just explained, in November 2024, in the lead up to the election results. Previously, we've seen this in 2022 when there was widespread chat about an oncoming recession. It became a little bit of a situation like in the story where the boy cries wolf. And there was no formal declaration of a recession, but it was priced in for the entire year with so much of a snowball effect that the markets really tumbled down for 10 months of the year in 2022. A couple of points that I would like to mention here is that there's a lot of fear that is in people's minds around volatility in the market. But I would really like to normalize this with all platforms of content that I'm speaking on, to say that if there was no volatility and if the market was simply just going up in a straight line, there would be no opportunities for us to buy low and sell high. There would be no opportunities for us to kind of get into the market at good sale prices and then sell our positions at profitable prices. Volatility is our friend. We need to simply just understand how to use it to our advantage. So if the big money is acting on the perception of news that I just discussed, it doesn't mean that we need to keep on top of the news and we need to kind of react on the basis of the news, because by the time the news reaches us as retail investors, it's almost too late. When we're talking about big money, they have teams of people who are clued into the news when it's not actually reached the newspapers. So they have the right contacts, they have the right they have ears in the right places that kind of bring them the news, and then they react on it, and then they place their bets based on the whispers that they hear from around the industry. For us, our basis of the news would be very much when the move has been made, when it comes on a newspaper, in a newspaper or on social media these days. It's very much reporting something that has happened, whether it is, let's say, Trump having won the elections, or a hedge fund having made a move, Warren Buffett having already sold a certain amount of shares, so on and so forth. But the decision-making process is very much before that. This is why we cannot base our decisions based on news, which is the biggest kind of error that I see novice investors, retail investors like you and me, doing. Or this is a big block that I see people, especially women, which kind of holds them back from investing, because they don't see themselves as being as clued into news as they think is required to be a good investor, which is not the case at all. We are not basing our decisions on news. We are simply just trying to understand the market patterns and then jump onto the bandwagon when it's right for us, when we are maximizing our returns based on the big money moves. So that's point number one as a takeaway. Point number two is a reflection of what we just said about the volatility, which is that the market does not move linearly in a straight line, and it shouldn't. It does not. It shouldn't. It's not normal for it to move up in a straight line. It always goes up and down, up and down. A lot of my previous mentors, teachers have called it the breathing in and breathing out of the market. So the market is going to breathe in and it's going to breathe out. It's going to breathe in and it's going to breathe out. This breathing in and out shows as, up and down on the charts as well, on stock charts as well. And we learn to study these charts and these movements in technical analysis, which is what I tend to specialize on, and I teach my clients in SheInvest if you come to me for learning stock market investments. Each of these breathing in and out lasts up to about a couple of weeks. These movements which are going up and down are called swings. And that's why the type of trading that I generally do and I teach my clients is called swing trading, where we stay in a trade from up to a couple of days to a few weeks, a couple of months, I would say. And this is the middle path to the extremes of being super risky and being very risk averse. It's also the middle path to being super conservative in returns versus being super growth focused, which generally comes with a big amount of risk as well. Last but not the least, it comes with the advantage of not being glued to your screen, whether it's to read news constantly or checking minute movements on charts. So it works really well for all of us who have busy and full lives and like to do a lot of things apart from just stock market investments. So this was just a very short update on the market moves in the month of November. I will soon have an episode coming out on psychological levels and resistance. Stay tuned for that. We'll speak next time. We would really appreciate your feedback as reviews on the podcast app you tune in from. Support us also by sharing this podcast with 3 of your besties who would benefit from being fantastic.